Welcome to Chapter 11, Retail Distribution. This chapter explains how a mutual fund moves from a portfolio manager's desk into a real investor's account. That journey includes the fund sponsor, principal underwriter, broker-dealer, investment advisor, platform, custodian, record keeper, and financial professional. Each party may provide a legitimate service, and each may also introduce cost, incentive, or control questions. Retail distribution is therefore not just sales, it is the operating system that combines access, advice, product selection, compensation, disclosure, transaction processing, and ongoing service. We will trace the investor dollar, compare commission and fee-based relationships, decode share classes, examine platform economics, and apply regulation best interest and fiduciary reasoning to actual recommendations. The key habit is to follow both the money and the responsibility. A fund may be excellent, yet the channel, share class, or account structure may still be wrong for the investor. By the end, you should be able to explain not only what was recommended, but who was paid, what service was delivered, what alternatives were available, and why the complete relationship fits the client. Retail distribution has changed dramatically. Front-end loads and transaction commissions once made the price of access highly visible. Today, most long-term mutual fund sales occur through no-load structures without 12b1 fees, and many brokerage platforms advertise $0 trades. That is progress, but it is not the same as free distribution. Advice may be priced through an asset-based fee. Platforms may receive servicing or data payments. Investors may pay account charges, spreads, taxes, or the opportunity cost of holding unsuitable products. During the zero commission wars, the storefront price fell to zero, but the business model did not take a vow of poverty. Revenue moved. The analytical question is therefore not, does a cost exist? It is. Who pays it? Where does it appear? What service supports it? And can the payment influence the recommendation? Regulation. Best interest adds disclosure, care, conflict, and compliance obligations to broker recommendations. But a rule cannot replace careful fact-finding. Zero commission is a price tag, not a business model. Somewhere in the system, someone still has a revenue line. This chapter develops 4 practical skills. First, map the distribution chain. You should be able to trace a fund from the sponsor and principal underwriter through a broker-dealer, advisor, platform, and financial professional to the retail shareholder. Second, decode compensation. You should understand loads, 12b1 fees, revenue sharing, sub-transfer agency payments, advisory fees, platform charges, and clean shares. Third, apply the share class rules. Breakpoints, rights of accumulation, householding, and letters of intent can materially change the cost of a recommendation. Fourth, judge the conduct standard. A broker operating under regulation best interest and an investment advisor operating under a fiduciary framework do not have identical legal structures, yet both require a defensible connection between investor facts and the recommendation. The chapter is not asking you to memorize a catalog of fees, it is asking you to reconstruct the investor experience and the business model at the same time. If you can explain who does what, who pays whom, what alternatives were reasonably available, and why the selected arrangement fits, you understand retail distribution. 4 connected questions organize the module. First, what is the distribution ecosystem? We need to identify the sponsor, distributor, broker-dealer, registered investment advisor, platform representative, and shareholder. Then understand where duties and data move between them. Second, what is the compensation stack? Sales charges, 12b1 fees, advisory fees, revenue sharing, record-keeping payments, and account charges can appear at different levels. Third, what conduct standard applies. Disclosure, care, conflict mitigation, supervision, and documentation should shape the recommendation process. Fourth, what decision is the investor actually making? The answer includes the channel, service model, share class, expected holding period, and total relationship cost. These questions form a chain. The ecosystem determines which products are available. The compensation affects incentives. The conduct standard controls how those incentives are managed. The investor facts determine whether the result is defensible. Distribution is part access, part service, part economics, and part accountability. Ignore any one of those, and the analysis starts to resemble a restaurant review that discusses only the menu and forgets the bill. The investor may see one brand, but several firms can divide the work. The fund sponsor designs the product, manages the portfolio, and supports distribution. The principal underwriter contracts with the fund and coordinates the public offering of shares. A broker-dealer maintains selling agreements, supervises representatives, and processes transactions. A registered investment advisor provides portfolio advice, often for a separate asset-based or flat fee. A platform or custodian provides shelf access, account infrastructure, omnibus record keeping, and service. The financial professional translates products into recommendations, planning, and ongoing communication. This network creates scale because each specialist can serve many funds and investors. It also creates opacity. The fund transfer agent may see one omnibus platform account, while the platform maintains thousands of underlying shareholders. That means data sharing, supervision, fee disclosure, and reconciliation become essential. Think of the investor relationship as a relay race. The baton is money and information. Every handoff needs a clear owner, a timestamp, and evidence that the next runner actually received it. The investor dollar moves through 6 stages, and information does not always travel on exactly the same path as cash. First is need. The investor and professional identify the goal, risk tolerance, time horizon, account type, tax setting, and service needs. Second is screen. The professional or platform narrows the universe using research, shelf policy, cost, eligibility, and due diligence. Third is recommend. A fund, share class, and amount are selected with conflicts and disclosures addressed. Fourth is order. The broker, advisor, or platform accepts and timestamps the instruction. Fifth is settle. Cash and transaction data reach the fund or its agent, and shares are issued at the applicable net asset value. Sixth is service. Statements, tax reporting, exchanges, withdrawals, monitoring, and advice continue after the sale. The recommendation is therefore one moment in a relationship that can last decades. A sales process that ends when the confirmation prints is incomplete. The control questions are simple. Were the investor facts accurate? Was the universe reasonable? Was the class eligible? Was the order timely? Did the transaction reconcile? And is the promised service actually being delivered? A fund does not earn platform shelf space through performance alone. The platform first evaluates investment process, philosophy, benchmark, people, capacity, and risk controls. It examines price and whether the share class expenses make sense for the value offered. It considers demand, including advisor interest, investor need, product differentiation, and brand. Operations matter because trading, data, tax reporting, service levels, and intermediary connectivity must work every day. Economics matter because platform and servicing arrangements must be sustainable and properly disclosed. Risk and reputation matter because compliance problems, complexity, concentration, liquidity, or headline exposure can create costs far beyond a weak quarter. A fund can have an excellent manager and still fail the shelf review because its data feeds break, its service is poor, or its structure creates avoidable risk. The shelf is not a hall of fame. It is a governed product menu. That matters because placement influences what advisors and investors see. Selection criteria should therefore be documented, repeatable, and separated as much as possible from payments that could buy attention without buying investor value. Transaction-based and fee-based relationships solve different problems and create different incentives. In a commission model, compensation is often triggered when a product is purchased or sold. That may fit an investor who trades infrequently and needs limited episodic help. The conflict is that product choice or transaction frequency can affect pay. The cost may be visible upfront or contingent, and it may decline with investment size or holding period. In a fee-based advisory model, an asset-based or flat fee pays for ongoing planning, allocation, monitoring, and behavioral coaching. That may fit an investor with a complex financial life, but it creates its own incentives around gathering assets, retaining assets, and charging on cash or low service accounts. A small annual percentage can compound into more than an occasional commission. Neither model gets a moral halo. The investor should compare the complete relationship over the expected holding period and confirm what ongoing service is promised. The invoice can arrive at the beginning, every quarter, or somewhere inside the product. It still arrives. The defensible model is the one whose service, total cost, conflicts, and expected behavior fit the investor. Total retail cost is broader than the fund expense ratio. Start with fund level expenses for management, administration, custody, distribution, and other operating services. Add relationship level charges such as advisory, brokerage, platform, wrap, account, planning, or subscription fees. Then consider frictions, sales charges, bid-ask spreads, transfer charges, cash drag, taxes, and trading costs. Finally, consider behavior. Performance chasing, panic selling, unsuitable risk, and unnecessary turnover can cost more than the line items investors debate most loudly. The illustration on this slide combines a 35 basis point fund expense, a 90 basis point advisory fee, and 10 basis points of estimated friction, producing roughly 1.35% before taxes and behavior. Do not add percentages mechanically. Some fees may already include services counted elsewhere, and behavior costs are estimates, not invoices. But the stack forces the right discovery questions. A low-cost fund inside an expensive low-service relationship may not be a bargain. A higher-cost relationship may be defensible if planning and coaching materially improve outcomes. The point is not cheapest at all costs. The point is value after all costs. Share classes are different pricing and distribution packages wrapped around the same underlying portfolio. Class A shares often combine a front-end sales charge with lower ongoing distribution expenses and breakpoint eligibility. Class C shares often avoid the traditional front load but carry higher ongoing expenses and may impose a contingent deferred charge on early redemption. Institutional classes usually have lower expenses for qualifying investors, plans, or platforms. Clean shares remove embedded intermediary compensation, so the platform can price advice or service separately. Retirement shares are designed around defined contribution record keeping and plan economics. No-load retail classes avoid a traditional sales load, but the investor may still pay account or advice fees elsewhere. This is the financial version of passengers sitting on the same airplane with different tickets, fees, and boarding rules. The portfolio can be identical while the investor's net return differs. The recommendation must therefore test eligibility, purchase size, expected holding period, other household assets, future contributions, platform rules, and service model. Choosing the fund family is not the end of the analysis. The ticker itself can change the invoice. Platform payments should be analyzed by source, service, and conflict. A 12B1 fee is paid from fund assets for distribution or shareholder service and appears in operating expenses. Revenue sharing generally comes from the sponsor's own resources and may support shelf access, marketing, data, conferences, or platform services. Sub-transfer agency and record-keeping payments compensate intermediaries for maintaining underlying accounts and processing shareholder activity that the fund's transfer agent would otherwise perform. Direct account fees include advisory, wrap, brokerage, custody, subscription, or planning charges. None of these labels proves that a payment is improper. Real services cost money. The control question is whether compensation can influence product selection, placement, or service, and whether that influence is disclosed and managed. Follow the money without assuming every payment is a scandal, but do not assume a payment is harmless merely because it has a technical name. A conflict can wear a suit, carry an acronym, and still be a conflict. The recommendation record should identify who pays, who receives, what service is provided, and what lower cost or differently compensated alternatives were reasonably available. The trend on this slide is decisive. The share of gross sales of long-term mutual funds through no-load funds without 12B1 fees rose from 46% in 2000 to 59% in 2005, 68% in 2010, 79% in 2015, 88% in 2020, and 92% in 2025. That is a major change in product packaging and channel economics. It reflects open architecture, fee-based advice, institutional share access, retirement platforms, competition, and investor sensitivity to visible fund charges. But the chart does not show that distribution became free. It shows that compensation migrated away from traditional loads and embedded fund fees toward advisory, platform, account, and separately priced services. The industry did not suddenly become charitable. It changed where the revenue appears. Also notice the limitation. Gross sales share does not tell us whether every investor received better service, lower total cost, or more suitable advice. The correct conclusion is structural, not celebratory. No load became the norm, and the analyst must now look beyond the prospectus load table to understand the full relationship. Retail distribution evolved through several waves. In the 1980s, commission sales and share class packaging expanded. In 1992, fund supermarkets made it easier to hold many fund families in one brokerage account. During the 2000s, fee-based advisory platforms and institutional share access grew. In the 2010s, robo-advice, model portfolios, digital onboarding, and zero commissions changed how investors accessed products. In 2020, Regulation Best Interest created a new conduct framework for broker recommendations. By 2025, no-load funds without 12B1 fees represented 92% of gross long-term fund sales. Each milestone changed a different part of the system. Fund supermarkets changed access. Fee-based advice changed compensation. Digital platforms changed scale and service delivery. Regulation changed documentation and conflict expectations. The investor went from meeting a product salesperson across a desk to receiving a model portfolio through an app, but conflicts can fit inside a smartphone just as easily as inside a sales brochure. Technology changes the interface. It does not eliminate the need to understand incentives, alternatives, and total cost. This case separates fund suitability from recommendation quality. The SEC's Share Class Selection Disclosure Initiative focused on advisors who placed clients in share classes that paid 12B1 fees when lower cost classes of the same fund were available. In 2019, the SEC announced settlements with 79 advisors and restitution exceeding $125 million. The underlying investment strategies may have been reasonable. The failure was more specific. Eligible clients paid an avoidable expense, the advisor or affiliate received compensation, and the conflict was not adequately disclosed. The portfolio did not change. The invoice did. A sound control process would test institutional, clean, no load, and transaction fee alternatives before the trade. It would identify who receives the payment, provide clear and specific conflict disclosure, document why the selected class fits, and monitor accounts for conversion or remediation. Generic language saying that a firm may receive compensation is not the same as telling the client that a less expensive class was available and the firm selected the class that paid it. Best interest analysis reaches the class, account, platform, and reasonably available alternatives. This matrix is a discussion tool, not a universal ranking. A direct fund account may have relatively low advice intensity and limited embedded compensation. A self-directed brokerage adds platform access and tools, but may still leave the investor responsible for selection. A robo-advisor can provide automated allocation and rebalancing with modest human service. A fee-only registered investment advisor may provide extensive planning with compensation charged directly at the account level. A full-service broker may combine recommendations, transactions, and ongoing contact with economics that vary by product and account. An insurance channel may provide guarantees or specialized planning while adding product complexity and compensation layers. Actual firms can sit anywhere on the map. A self-directed platform may offer strong planning tools, and a fee-only advisor may deliver little beyond a quarterly statement. The point is to ask two questions. How much useful service does the investor receive, and where is the compensation located? Low embedded product compensation does not automatically mean low total cost. High service intensity does not automatically mean high value. The map begins the due diligence. It does not finish it. A defensible recommendation memo connects investor facts to product, class, channel, and ongoing service. Step 1 is the investor. Goal, account type, horizon, liquidity, tax status, risk capacity, knowledge, and service needs. Step 2 is the universe, reasonably available alternatives on the firm's platform, including lower cost share classes and different service models. Step 3 is the product, strategy, benchmark, risks, liquidity, manager capacity, performance, and portfolio role. Step 4 is cost, fund expenses, loads, advice fees, platform charges, taxes, and expected holding period. Step 5 is conflict, compensation, proprietary products, revenue sharing, quotas, and incentives that could influence selection. Step 6 is monitor. Define what would trigger review, conversion, rebalancing, replacement, or client communication. A memo that says only client seeks growth and this fund has good performance is not analysis. It is a fortune cookie with a ticker symbol. The record should explain why this fund, this class, this account, and this service arrangement fit better than reasonable alternatives. It should also make clear what the firm promises to do after the purchase. Consider the client on this slide. $150,000 will be invested in the same balanced portfolio for at least 10 years. Class A has a breakpoint reduced front-end load and annual expenses of 0.55%. Class C has no front load and annual expenses of 1.30%. The institutional class costs 0.35%, but it sits inside an advisory account charging 0.90% for a combined stated annual cost of roughly 1.25% before other frictions. Do not choose yet. First, determine the actual Class A sales charge after rights of accumulation, householding, and any letter of intent. Second, test the 10-year holding period. Class C carries 75 basis points more in annual fund expense than Class A, so avoiding the front load may become expensive over time. Third, define the advisory service, annual planning, tax coordination, rebalancing, withdrawal strategy, and behavioral coaching may justify a fee, but a quarterly email probably does not. Fourth, document alternatives, conflicts, termination costs, and assumptions. Same portfolio, 3 invoices. Pause the video and build a recommendation that includes 1 calculation, 1 missing fact, 1 conflict, and 1 monitoring trigger. Pause the video and answer all 4 questions before continuing. Question 1, what does a mutual fund breakpoint generally reduce? The correct answer is a front-end sales charge. It does not reduce net asset value, volatility, portfolio duration, or capital gain tax rates. Question 2, what is revenue sharing? It is a sponsor payment from the sponsor's own resources for distribution, platform access, data, marketing, or support. It is not a mandatory fund dividend, a performance fee, or a redemption gate. Question 3, why can clean shares improve transparency? They separate intermediary compensation from fund expenses, allowing the platform or advisor to price service directly. Clean shares do not guarantee alpha, eliminate taxes, or trade intraday merely because they are clean. Question 4, what should drive a share class recommendation? Investor facts, eligibility, total cost, expected holding period, service, conflicts, and reasonably available alternatives. The highest commission, newest ticker, or largest fund is not a decision rule. Review any item you missed and explain the operating logic behind the answer. The objective is not 4 memorized letters. It is the habit of connecting cost and compensation to investor fit. Carry 6 claims forward. First, distribution is a system. Multiple firms divide manufacturing, advice, custody, processing, and service. Second, costs move. Traditional loads declined, but advice, platform, account, tax, and behavior costs remain. Third, share class is a decision. The same portfolio can produce materially different net results through different classes. Fourth, compensation creates conflicts. Embedded and direct payments require identification, disclosure, mitigation, supervision, and evidence. Fifth, standards require documentation. Best interest and fiduciary reasoning should reach the product, class, account, channel, and reasonably available alternatives. Sixth, service must earn its price. A higher cost relationship is defensible only when the investor receives commensurate value. The practical habit is to follow the money before the money follows you. Ask who performs the service, who pays, who receives, what alternative exists, and what happens after the sale. Chapter 12 takes this distribution system into the workplace where defaults, matching formulas, record keepers, target date funds, and participant behavior can shape retirement outcomes for decades. This final page is the refresh register for Chapter 11. Posen and Hamacher provide the operating architecture. The Investment Company Institute sources update the shift toward no-load structures and the scale of modern distribution. The SEC materials explain regulation best interest, standards of conduct, and the share class selection disclosure initiative. FINRA's Breakpoint and mutual fund class resources provide practical guidance on sales charge discounts and class differences. Do not read the long web addresses aloud. Instead, notice what each source can support. A rule or enforcement release establishes a regulatory requirement or documented case. Industry statistics describe market structure. Investor education explains concepts in plain language. None of those sources alone proves that a specific recommendation is appropriate. That conclusion still requires investor facts, available alternatives, cost analysis, conflict review, and documentation. The durable questions are straightforward. Who is in the distribution chain? What service is delivered? Where is compensation located? What class is available? What standard applies? And how will the relationship be monitored? Chapter 12 now moves into retirement saving through 401k plans, where plan design and default choices become a distribution system of their own.